I'm Alex Felix, the CIO here at CoinFund, and as Jake mentioned, we've been looking at the space. I think we're excited about it for a couple reasons. This year, token models have moved away from sort of payment tokens and into what people are calling kind of work tokens or medallion tokens, where in order to unlock the value from an opportunity, you may have to participate. We had a question in the panel here, which is, why do it yourself when you can kind of partner with someone who may be able to do that for you? And I think that's the exact topic of this panel here, is to talk about some of the experts that are looking at this opportunity from a company perspective. And everyone's going to make that kind of risk-reward trade-off between, do I do it myself or do I partner with someone who's an expert in a particular network or a particular set of opportunities. The space is kind of vast in how we think it will evolve. So it's my pleasure to introduce the panelists here tonight. I'll have each of them let you know what they're doing, and I want them to describe your sort of role within this broader economy when you kind of make that introduction.
Sure. So, hi everyone. Thank you so much for hosting to CoinFund and Cambrial. My name is Axel Ericsson, and I'm a co-founder at a company that was called One Protocol, but we changed our name to Vest fairly recently. And essentially what we're building is a delegation marketplace. And a delegation marketplace is a place where people running validators can come and list, and then users that have essentially no idea who the players are in the system, they can go to the to the marketplace, they can get a vetted list of the different validators. And then ideally it includes some sort of nice features as well, like the ability to very easily delegate and track your returns.
Yeah, hi everyone. My name is Crain. I've done a few things. One of them that some people may know, I started a podcast called Epicenter, and I've been doing that for many years, including we did very recently an episode with the CoinFund guys about this concept called generalized mining. And then I've also been sort of working around the proof of stake space for a while. I joined in January 2017 the Tenement Cosmos project and was like chief operating officer of that. And then at the end of 2017, I started working on a company called Course One. And so far we've spent a lot of time basically building validators and validating infrastructure for proof of stake networks. And we've also spent a lot of time kind of thinking about how does the user experience change in the future? How do wallets need to change? Like, how can you actually have automation around tokens so that a lot of these complex behaviors that will be required by these networks, how can they be done for users? So this is what we've been working on.
So I'm Darren Langley. I work for Rocketpool. So Rocketpool is a decentralized proof of stake infrastructure service. So the short answer is that proof of stake has a lot of kind of barriers to entry. So we kind of democratize that. As a staker, it means that you need less ETH than we're Ethereum based. So you need less ETH than the 32 required. Plus you don't need any technical skills or run a node 24/7. As a node operator, you can use less than the 16. They use less than the 32 ETH, so you use 16 instead. And you also earn extra income from people that we assign to your node. As businesses, we provide like seamless integration, so you can kind of provide staking services for your customers, and that's us.
Cool. Hey, I'm Adrian. I'm one of the founders of Cryptium Labs. I've done a few things in this space, but I'll focus on Cryptium Labs today. Cryptium Labs is fundamentally a bet that proof of stake works, right? Like Cryptium Labs is a bet that proof of stake works. So the first thing we do is secure and available validation. So we validate. We've set up secure infrastructure in the Swiss mountains to run validators for almost all reasonable proof of stake networks. Currently, this is only Tether so far, since it's like the first major blockchain that actually went live. Secondly, we do a lot of research and development around these protocols. So the reason why Ethereum sort of picked up was because a bunch of other people started developing tools around the Ethereum ecosystem. And validators are sort of placed in this very nice position where they have some cash flow that they can put to good use by developing these tools. And for example, for Tezos specifically, at launch there was a lot of tooling missing, specifically with regards to paying your delegators. So you had no way, it was not in protocol payment, so we had to write accounting tooling that sort of automatically figured out how much our delegators should be paid and then automatically send those transactions. And then the third part is educate the community about these networks, right? Like a lot of people actually have no idea how proof of stake works or how delegation works or how to even move their Tezos from their fundraiser accounts into like ledgers. So we spend a lot of time on simply writing articles and doing videos that explains people basic proof of stake concepts, and also network specific things like how do you secure Tezos by moving them into a ledger or something. Yeah, cool, thanks.
So I think it's really interesting that tonight we have two companies that are sort of building the validators, and then two companies that are focused on kind of the delegation pools around being a meta layer on top of the validator marketplace. And one of the questions that we've been thinking about is, how does a validator differentiate itself? And what does that look like? What are some of the kind of KPIs? Is it uptime? Is it security? Is it a whole host of potential ways that you can separate yourself and earn more delegation, and that pools can sort of show on their website in order to help a potential delegator understand which validator they may want to delegate to, or a variety of validators that they may spread their stakes across. So be interested in your thoughts on what differentiates validators.
I can give it a shot. So broadly speaking, there are two sort of important types of metrics, and they are essentially on-chain metrics and off-chain metrics. So on-chain metrics would be things like, let's say you have a proof of stake blockchain with delegation built in. Then you would look at the size of the validator stake and the fee that it's taking. And these are on-chain metrics because they can be seen on-chain. And if that's all you care about, then it's pretty easy to create different types of rankings between machines and sort of compare them. And you can essentially think about the ratio between the amount that the machine has at stake and the amount that the users have contributed as sort of the risk that you're taking as the user. It's arguably more risky to contribute tokens to a machine that has almost nothing at stake versus a machine that has a lot at stake. So these are the on-chain metrics. And the second category broadly is the reputation that a miner has, and you can bundle all these things like the specific rig, who's running it, how likely they are to stay around for a long time. But really, all that goes into the reputation of a miner and this sort of fuzzy metric of what makes a user choose a specific machine beyond what the on-chain metrics tell you. So how to represent that is obviously extremely tricky, and essentially, what you would want to do essentially is have many different types of ranking algorithms, and then have users essentially look at several different ones to make a bit more of an informed decision than just looking at the on-chain metrics. And then the issue is, let's say that someone like Coinbase decides to run a machine. How can we create ranking algorithms and ways for users to understand these more fuzzy data points without users essentially just defaulting to like the main big one that has a pretty good brand name?
So I think it varies quite a lot by network. So if you look at like Tezos, right, then for example, as a user, I don't care about the security of the validator, but I care, for example, okay, do they pay out on time? What is the fee? Maybe about governance. In something like Cosmos, I think in the first year, security is going to be one of the most important factors because you have this risk of slashing, right? So there's this risk of losing a lot of money. So I think it depends a bit, but if you look at Cosmos, I think in the beginning, security is the key differentiator, and then afterwards, a lot of different things come up. I think you mentioned the whole question of user experience. I think that's like a really key thing, and that also potentially validators themselves can do a lot to like help with that. And And then I think in the longer term, a lot of auxiliary things will be developed, right? So this would be like financial products, maybe like insurance, like kind of default insurance, or like bonds, so you have liquidity even on stake tokens. And so I think, being a participant in that and basically building like a superior product by continually, enhancing a validator, I think is going to be, a powerful way to go.
So I think initially in networks such as Cosmos, security will be not as important actually. So I think most people don't realize how important security is. And so I think the first 6 months we'll see a bunch of people that like delegate to the lowest fee providers, and then we'll see a wave of validators getting hacked and getting slashed, and all of a sudden fees don't matter anymore, and suddenly people care a lot more about security. So I think in the short term, for most of these networks, security is actually like not on the forefront of most people's mind, sadly. The other thing is, even in networks like Tezos, security is still pretty important, mostly because delegation is rather sticky. So, like, if you delegate to someone and they sort of lose their private key, and you may not check again for another 3 months, you start losing a lot of income in those 3 months, plus all your fees are at risk. So the view we've taken effectively on how to differentiate ourselves as a validator or as a proof of stake company is like, do something useful in each network, right? Like, do something that's useful to the participants that actually hold the token, whether that is you offer them a great sort of delegation service, or you write articles, or you produce videos, or you write tooling that makes the token more useful. So yeah, I think fundamentally validators should focus on doing something useful for network participants, and that's how you differentiate yourself.
I think in the general case, it's reliability, security. Are they open source and kind of transparent? Are they? Our model is kind of slightly different because we're aiming to be a decentralized kind of node operator network. So all of our node operators have skin in the game because they've essentially staking the same amount as we're giving them. So if they lose money, they lose money, and as much as the clients that we're assigning them. So that's quite a powerful incentive for them to actually kind of maintain that reliability. So that's kind of our ethos, I guess.
Excellent. I know someone here mentioned on the panel, will proof of stake work, and will kind of capital security models work? But I'd be curious to hear your view on the scope of this opportunity set. Will there be thousands of these networks that are able to leverage kind of proof of stake and generalized mining opportunities, or will there be just a couple? And what is your business model in relationship to how to capture value from that? Is it to go really deep on a couple networks and try to amass lots of delegation, or is it to try and be as broad as possible and sort of build out a name brand in the space?
So I think there were two parts to that question. The first one was what's the scope of proof of stake, and I think it's helpful to sort of unbundle staking from proof of stake. So there are many other protocols that that use staking as a way to incentivize the machines on the network to act correctly, but they really have nothing to do with consensus protocols. And when you get into things like proof of stake, there are all these proof of stake specific attacks that don't really have solutions. They just essentially mean that we have to change our assumptions about how these systems work. So this would be something like, there's a long range attack usually for most proof of stake implementations, and we can't solve that. It just means that we change, the assumptions of how the systems work. So just focusing on staking, our take on this is essentially that it's sort of a massive opportunity, and the reason is that it makes sense as a way to incentivize the machines. Broadly speaking, you can either use opportunity cost as incentives. So this would be in proof of work, where you're simply paying the machines a lot for each unit of work that they perform correctly, such that there is some cost to not doing it correctly, or you can go with staking, where the machine has put up a large security deposit that's sort of at risk. And the idea, the core benefit there is really unbundling the amount of money that the users are paying from the security of the system. So in proof of work, in order to have sort of a certain amount of security, you essentially need block rewards and transaction fees to get that security. Otherwise, someone else can always come in and bribe the machines to do something else. Whereas in staking, it doesn't really matter what the traffic is on the network and what the transaction fees are in the inflation. What matters is the amount of loss for the machines. So in general, we think this makes a lot of sense as sort of an incentive mechanism for staking protocols broadly. And then the question of whether it's sort of a long tail kind of thing, where literally every sort of digital service you can imagine is going to have sort of an open marketplace that uses staking as the incentive, or we're just going to see essentially a couple of base services that are consensus, computation, and things like that. It's this very open question and remains to be seen.
So we'll probably have, my perspective on this is that it's very unlikely that we have hundreds of thousands of different asset classes, right? 99% of all these tokens will go away. No normal human being wants to deal with 100 different assets. It's no reasonable human being maintains 100 different currency accounts. So I think most of these tokens will go away, and we'll essentially use we start reusing the same assets within different proof of stake networks. Because the other thing I think what will happen is that we will have hundreds of thousands of different state machines. And whether those state machines be Ethereum smart contracts or their own blockchain or their own Cosmos zones or their own Polkadot parachains is yet to be seen. But I think we'll see a lot of different state machines. But we'll probably reuse a lot of the underlying assets to secure the same state machines, or to secure different state machines.
So I think Jake before kind of outlined and described well the enormous variety of different kind of mechanisms and services needed. And yeah, you can speak about staking, right? But then if you have things like layer 2, right? Maybe it's not staking, but running some sort of Raiden hub is actually quite similar in terms of infrastructure needed. And in terms of properties. And then I think if you're going to look at a lot of different decentralized financial instruments where maybe you have insurance and you have some sort of security collateral, I think it all looks fairly similar, right? In that you have to have these automated services that issue transactions on chain. They may acquire capital. They have to have some logic. So I do think there's going to be an enormous variety of different use cases for that. Now, when it comes to the base layer proof of stake, I agree it's somewhat open. I do tend to think that there's going to be a lot of different chains, even if they may just be a few consensus algorithms that will get used, right? So then it will be quite easy potentially to run validators on many different chains without having a huge amount of extra work. So yeah.
So the big movement obviously is decentralization, but with decentralization you kind of need to incentivize those individual parties to do what you want them to do. So using capital and bonding capital in particular is a very common mechanism, and I don't see it going away anytime soon. I think it's going to continue. So that's there's a very broad scope in terms of that. In terms of networks, for us, we're focusing on Ethereum because we think it has the kind of best kind of market potential, but we're kind of open to other networks. And the only problem is that it's quite non-trivial to develop for each and every network. So we have to be kind of selective and choose ones that we feel have the best potential. That's us.
That's great. Thank you, guys. I think I take the sort of opposite view on how many tokens will be out there in the world. As some of the panelists on this side mentioned, probably a lot. And I think in a digital environment, things can shapeshift. While you may have one currency that you hold, using that throughout the ecosystem in a digital environment should be fairly seamless as soon as we can obfuscate away a lot of the underlying complexity and sort of minimize frictions across the exchange of those assets. So while we I do think we see a lot of different models and how whether or not people actually hold the tokens versus they services are still denominated in them is kind of up for debate. Let me know what you guys think about the sort of skin in the game issue. A lot of investors out there are used to losing. The price of their assets may go down, but they're not used to and set up for a variety of reasons, tax and otherwise, losing quantity of tokens. So slashing is both a very powerful model as it helps to get rid of bad actors, but it also prospectively has kind of knock-on effects to who can actually participate in these opportunities for a variety of reasons. As well as how you guys may navigate. As a Tezos baker, I need to have X amount of tokens that our company actually owns to run a validator versus Ethereum proof of stake, where you may not have that skin in the game problem, or it may be much lower barrier to entry. Just curious on either of those topics.
I can give it a shot. So it's kind of funny in some ways how this works. If you keep your validator online and you do everything correctly, then there's sort of a predictable return that's fairly reasonable in like the single-digit percentages probably. But then if you do anything else, you lose. So in some ways, it's not like participating in these networks is this like bounded downside, huge upside sort of opportunity. It's more like if you've already committed to holding these tokens for a longer period of time, and you want to contribute to the network at the same time and earn some sort of token denominated returns, you want to do this. And essentially, what you would want to do to protect yourself is fairly straightforward. You would want to look into diversifying across several different machines with risk profiles. The idea there is that if you have the choice between giving your tokens to one machine that has a certain risk profile versus splitting it among 10,000 machines that all have the same risk profile, you always choose the latter because it reduces the variance on returns, which is the same as reducing risk. And then you would want to look at more advanced schemes like insurance schemes. But at the end of the day, it's really about picking the machines correctly.
Yeah, so I think right now we're seeing sometimes that there's this bundling, right, between like the entity staking and then also maybe needing some token and having the slashing risk. And I do think we are going to see more of a sort of a splitting up of these functions, right, where you may have different types of, maybe somebody can take the slashing risk and they get a much higher return, and somebody gets a low return, but they kind of, are absolved from the slashing risk. So I think we're going to see a lot of stuff like that. And then probably it would also cater to investors that, may not be able to have the slashing exposure and have other parties take over the risk. But, that's some ways away. I do think the skin in the, at least if we look at the Cosmos example, then I think skin in the game is like the significance of that is overestimated. Because in the end, if I delegate to a particular validator, and then if they mess up, then I'm gonna get slashed and I'm gonna lose some coins, right? So what I really care about is that they don't get slashed. Now, if they get slashed and they also lose some of their own coins, it doesn't help me, right? I'm still getting slashed. So you really care about the quality of the validator and their security more than whether they also have stake in the game. And of course, in some other networks, different, right? In Tezos, if they like actually enforce the validator to have their own bond, then that kind of gives that significance on its own. But I think when you have with things like Ethereum and smart contracts, of course, you can have anything in between, right? You could just say, okay, the slashing risk gets proportionally split in everyone delegating to a validator, or you could have, okay, the validator I absorb the first 20% of the slashing risk, or you have different customer groups that can have different risk profiles. So I think we're going to see a huge variety in different approaches here.
So on the quantity versus price, That's actually one reason why I think most funds aren't like set up very well to run validators at the same time, right? Because it's hard to explain to a fund investor why suddenly 20% of that fund is gone. Slashing, there are two risks, right? There's liveness slashing and there's safety slashing. So liveness slashing means you go down and you don't produce blocks anymore, and you don't participate in consensus anymore, and you may get punished for that. And most likely, at the very least, you will get punished by not getting any more rewards. And so this is actually fairly easy to insure against. So like with Cryptium Labs and Tezos, we essentially, it doesn't matter if we miss a block, we pay our delegates anyway. Like we pay our delegates if we had a perfect uptime. And I expect most validators to eventually offer this as sort of the default, because it's like a sane default, right? It's like my skill determines on, like I have an incentive to be better at this, and I think it's unfair to pass this on as a risk to the delegators. So as an extension to this, I also think that over the long run, the validators will start offering slashing insurances. This may not come cheap. They may charge higher fees, but like just the same way that if Coinbase gets hacked, they don't tell anyone about it. They like keep quiet and like pay people anyway. It's like the same way a bank works. It's like a bank doesn't tell their customers when they lost $30 million. They like keep going, and it's like it's fine. They take it out of their own profit margins. And I would expect validators will effectively do the same thing. In validators, this is kind of weird because this is very public that you've got slashed, but I would expect that they cover this in any case. Yeah.
Thank you for that. We'll do one more question, then I want to make sure we leave a little bit of time for Q&A. And there's a lot of stuff we didn't get to cover, around, how these guys fit in with kind of exchanges and what sort of the future of exchanges are in this competitive landscape. But I think, if I were to ask one more question, it might be around, sort of good money and bad money in this space, and the concept of dark DAOs, on and off chain lending, and how that may affect, sort of how pools operate. On one hand, a pool is, just a collection of people trying to, do the right thing, and you guys will kind of validate that. But on the other hand, staying close to a network and understanding, what you actually have to vote on can be important when you're, when people delegate to you. Sort of like proxy voting is in traditional equities markets, and early on, most custodians would just take people's shares and not even vote them. And now, bigger firms have practices around what to recommend for voting proxy shares. So, just curious if you guys have any comments around just how complex this whole landscape might get with good money and bad money, and other incentives that can be structured kind of off chain for destroying a network and earning on the downside. There's a lot of ways to think about this, but just curious to hear any kind of final comments on that.
So like derivatives over staked assets are fascinating, and I'm very much looking forward once we like have tradable staked tokens, and whether they're like between different validators that traded at the same like sort of risk rate, and whether this sort of creates an exponential crisis because everyone assumes that all these validators have the same risk rates. In reality, they don't, and suddenly we have cascading failures. And I think, honestly, actually, like creating derivatives over staked assets will massively force networks to increase and validators to increase the underlying security of the network, right? Like because suddenly you have sort of this amplified attack scenario. Yeah.
Right. So do you want to?
Go ahead.
Sure. So just quickly on what Adrian said, fully agreed on the fact that just like having a secondary market where you can have pieces of stake that are traded, it's massively going to increase the amount of money at stake, and therefore the security of these systems. And you can usually even like get around certain like protocol level restrictions if you allow the stakes to be traded. So in like Casper FFG, there are these 4-month lockup periods before you can get your money out. Well, if you can sell your piece of stake, then you can get around that. On like good money, bad money, that's essentially broadly speaking a problem with governance. So if you allow your coin voters to directly vote on protocol updates, then it's very difficult to prevent people with like certain agendas to vote them through, and especially in sort of an anonymized setting.
like on the governance question, I think governance is probably the riskiest thing of proof of stake. And for some reason, all recent proof of stake networks tie itself to implement governance at the same time. And governance is probably by far the most untested and dangerous thing that a network can implement. I'm not saying networks shouldn't do it, but I'm just saying like be aware of the risk.
So the first step there is probably to like build some extra layer where the voting is separate from the delegation and the staking. So you can imagine, you have a bunch of tokens, and then you can find a validator that works with them. But then you can separate that and the returns from that from the voting and sell that off to someone else, ideally. But and then generally, like one way to frame why it's so difficult to do governance is like you have all of these token holders which may be unknown, and then in general we're trying to solve the issue of like how do these people that we have no idea who they are come together and produce outputs which are good for the system as a whole, for like a very complex system, and that's in the general case like completely unsolved, and even in specific cases very, very difficult.
I mean, I'm reasonably optimistic when it comes to proof of stake governance. I mean, of course, there's tons of mechanics that have to be figured out, and I'm sure lots of experiments will go wrong. I think actually, the normal user is not gonna care, not gonna vote, right? So I think if you try to replicate that and rely on like normal users to participate, and I think those systems won't work so well. But I think if it is, for example, like validators vote, but token holders can override, then I feel like that could be a balance, like how it is in Cosmos. Actually, I really like that governance model. So I think that is a way that you'll get a high participation, and I think you will get decisions that are in the network's interest overall, and I think in general regarding this this idea that okay, are you going to see people attack networks or short them and then go on there? I mean, I've been worried about that for a long time when it comes to proof of work, because in proof of work you have much less accountability. Like a miner can, attack a chain and they keep their entire hardware, and they don't really, the cost of attacking is quite low. And I think in proof of stake you generally have like really nice accountability, and you can slash people, and that's like extremely high punishment. And of course, the other thing that you can do is you can fork the chain, and you can again, if the attack is actually on chain, you know who did it, and you can cut them out. So on that side, I'm very bullish on the kind of game theoretic security of proof of stake. But probably people will make mistakes, and maybe there will be some holes that can be exploited.
I think because I'm a developer, so I come at it from a different angle. But when you're designing these things, you have to have the kind of ramifications in mind, and kind of design to as many attack scenarios as possible. But also, you need to kind of open up for innovation as well. So that's a big thing for us is kind of supporting, using the network effects of all these kind of great open finance kind of ecosystem that's emerging, and basically supporting that innovation.
Thank you all. We can take a couple questions from the audience.
Hello. So all this speech or discussion is with the assumption that proof of stake is already like a thing and it won't fail. But I think it's more of some kind of probability. And I just want to ask if you are sure that proof of stake is here to stay, if it's like in current form, if it's like sustainable, or if you think there is some probability it will fail, and what are the other consensus mechanisms you think may also be interesting. Thanks.
So proof of stake is not a consensus mechanism, right? Like proof of stake is a leader election mechanism. Consensus mechanisms are like something like tenement consensus, Aura, proof of work, like Nakamoto consensus. Those are the consensus mechanisms. Multiple processes on the network that come to consensus over like a binary value, for example. And then proof of stake is simply saying which machines, which keys are allowed to participate in this consensus process. I think there's absolute risk. it may not be very large, but there's a risk that proof of stake actually fails. Now, we could see that like the next 3 main projects start failing after a year or 2 because of like bad economic design choices in proof of stake. In the proof of stake implementation, that'd be very bad for proof of stake overall. However, I would say I'm very bullish on proof of stake working and like being here to stay.
So again, right? So it depends. What we talk about here? Are we talking about base layer proof of stake, or are we talking about all of those different ways of staking? I think when you talk about all of those different ways of staking, I think there's like 0 chance that's not going to happen. When you talk about base layer proof of stake as a way to secure like large public blockchains, then I also think that the chance of that not becoming kind of the dominant way of blockchains being secured, I think is, in my view, very, very low. So I would say like less than 5%, maybe 2% or something, because there's just so much better, right? The security, the speed, the throughput, the ability to have like multiple interconnected chains, like all of that is like an order of magnitude at least better with proof of stake than proof of work. That being said, I think when you talk about any specific particular implementation that doesn't work, I think there's a very substantial chance, or that there errors and there has to be changes made. So what's the timeline? That, I mean, that's a hard question, and maybe there's some attempts, and maybe Cosmos not going to work the way it's supposed to, and Polkadot and stuff like that, and maybe it has to be changes, and it's the next generation. So I think there's uncertainty there, but that proof of stake in general is the future of securing large public blockchain networks. Personally, I don't have doubts on that.
And to avoid repeating too much, fully agreed. Staking as a whole makes sense as an incentive mechanism. There are issues with implementing specific types of proof of stake. But the second part of the question was, are there interesting systems that sort of look into alternate designs? And what I would look at there are systems where block production is block proposing is proof of work with some other selection mechanism, and then you have staking on top of that to create some sort of finality or something like that. This is what the design of Casper FFG was, and it's likely that hybrid systems may turn out to be viable before we have some sort of full proof of stake system.
So with proof of stake systems, they're kind of relatively new, I guess, but there is so much cross-pollination between the teams and all of that sort of stuff. There's lots of people thinking about these problems. It kind of makes sense, and it as all the points before. So I think just because of the sheer amount of effort that's going into it, I think it's a very, very low chance of it failing.
We can take one more, and then one in the back there. If someone wants to send the mic.
Hello. I recently read a paper which claimed that proof of stake validators might be at risk of being subject to money transmission regulation in the US because a proof of stake validator essentially votes on a set of transactions that end up in the blockchain, whereas proof of work validators, one could argue that when a miner mines a block, there's no actual finality until that block is added in the chain, and so therefore regulators might not consider that to be money transmission. So I was wondering what you guys thought of that claim and other potential regulatory risks that proof of stake validators might face in the future.
Yeah, it's a tough question. I think the first team that kind of brought that forward to me was the Cadena team, who it's the difference between probabilistic and finality. I don't think, unfortunately, we have legal experts up here, and it's something that everyone is kind of looking into around whether or not we have non-custodial sort of proof of stake systems work or custodial ones, but it's a challenge. Does anyone have a particular view on it?
You should, if you're concerned about this, maybe don't headquarter in the US and don't run a validator out of the US. Fundamentally, you can arbitrage a legal system to figure out where this works. We picked our jurisdiction for precisely those reasons.
And beyond that, I'd be extremely surprised if the way the money transmission laws are sort of applied or interpreted here is, if there's no finality, then that's fine, and if there is some notion of finality, then all of a sudden you're a money transmitter. It's more likely that there'd be some sort of broad classification of a specific type of mining for a specific system that's classified as something. But then to sort of echo Adrian's point, you can sort of choose whether to be subject to a certain legal system, and then beyond that, I'd be hopeful about things like, let's say you have certain privacy coins where the miners, sure, they may propose blocks that then get voted on, but they may not actually know what those transactions are. So you could probably make an argument that if the miner is essentially just listening for messages, bundling them, and then rebroadcasting another message, then it's not actually transmitting money. It doesn't know what's in those transactions. They could be empty. The miner doesn't really know. So you could probably make an argument like that as well.
So regarding this particular point, I mean, I agree with Axel. I don't think it makes... So in proof of work mining, you can't say like a particular miner processed a particular transaction. Even if they mine that block, that transaction would have gotten processed anyway if it was maybe in the next block. And I think in proof of stake, it's basically the same way, right? Like you don't really have an ability to censor or process it, like censor a transaction as a particular validator. I think where regulatory questions do, so I do expect in this regard that it will probably be similar like with proof of work mining, and that validators will be mostly exempt. Now I think where the regulatory questions do come in, one is with the around delegation, so the relationship between a validator and its delegators, and I also think where regulatory questions probably get pretty difficult is not so much in proof of stake, but actually in layer 2 stuff. So things like Raiden and Lightning, operating a hub there, you literally are processing transactions, right? Like there's no really way to get around that. So I do think that is something that will probably be quite difficult to operate.
And I think that challenge cascades to a lot of resource networks that'll be up and coming, whether or not you're storing files, you're transcoding and streaming video. There are a lot of kind of complications around where censorship may come into play, and how some of the challenges that these guys just discussed there. So I think we'll have to adjourn this panel. We have a lot of other good panels coming up, so we thank you all for coming out and our great panelists tonight.